Hi, everybody. I'm Mace, your host of the Mad Mortgage Show, your source for no BS, in-depth mortgage discussion. Today, we are in Vegas at the ICE Mortgage Technology Experience, joined by Joe Tyrell. Thank you for being here.
Oh, thanks for having me.
So jumping right in March of 2020, I interviewed the CEO of a private company called Ellie Mae before this thing called COVID. Now I'm interviewing the successor, Joe Tyrell, the president of a division of a public company in the post-COVID era. So I think there's a lot there. Tell me what this ride has been like.
It's been pretty incredible. What's interesting is the culture of Ellie Mae hasn't changed. In fact, one of the things that was really interesting to us is when ICE first reached out to us, it was in June of 2020, so right at the height of the pandemic. And they said they wanted to fly out and meet with us in July. Mm-hmm. And so because of social distancing and because of all the restrictions in place, we had kind of this very clandestine meeting at our offices, our Ellie Mae corporate headquarters in Pleasanton, which is at kind of the northern tip of Silicon Valley. And there's nobody in the building. It's just me and Jonathan, and then Jeff Sprecher, the CEO of ICE, and Ben Jackson, the president of ICE. So they'd flown in, and just the four of us are in this empty building having this meeting that nobody knows is taking place. And I had prepared, the normal 77-page deck when you're going to potentially go through an acquisition to explain all the reasons why someone should buy us. And so Jeff and Ben walked into the room, and we did our introductions, and then said, "Okay, well, let's get into it." And Jeff stopped us and said, "We don't need to go through the presentation. We just flew out here because we want to talk to you about what your culture is like." We knew right then we had found the right home for Ellie Mae. And since then, this 2-year ride that we've been on has been incredible. The resources we now have available to us, without necessarily all of the focus of being public on our own, but being part of a public company that also has the New York Stock Exchange, a billion-dollar data business, it gives us all of the advantages of being a public company without any of the downside that we had when we were on our own. And so there literally isn't an entity that we don't have a relationship with at ICE in some way, shape, or form, whether it's through our data business or they're listed on the New York Stock Exchange or they're participants in our fixed income business or they're on the mortgage side. Mm. So it's been incredible.
So what was the biggest surprise for you through this process?
How quickly it went. So literally, we had that July meeting.
So did you get one of those offers like he did the other one where I'll just pay double? Or you didn't get that same offer?
Well, what's interesting is we were acquired. Ellie Mae was acquired. We were taken private when we were public by Thoma Bravo for about $4 billion. A year and a half later, we were sold to ICE for $11 billion.
So Thoma Bravo did pretty well.
Thoma Bravo did really well. And the reality is that when they bought us, the fundamentals of the business hadn't changed at all. What had happened is we had as a public company, we were the best performing stock on the New York Stock Exchange for over a year. Mm-hmm. And as the ups and downs of the market would hit other providers in our space, we continued to just perform through it. And so it was almost as if there was this pent up kind of bear energy, if you will, around, well, just wait. At some point, they're going to miss. And so when we were doing our third quarter earnings in 2019, we announced that we'd hit the profitability number, but we'd just missed on revenue. Mm-hmm. Well, it just so happened that in that quarter, the tech stocks were getting crushed. The real estate stocks were getting crushed. And so we found ourselves, we'd been hovering around 114, 115 as our stock price. And then in the matter of weeks after that earnings announcement, it jumped down to $65 per share. Mm-hmm. But the fundamentals of the business hadn't changed. And in fact, we actually outperformed from a profitability perspective. And we've always been telling people, we are a SaaS company, but what makes us different is we're actually profitable. Mm-hmm. So all the other SaaS companies out there, especially at the time, somebody like a Salesforce was just focusing on top line revenue growth. And so a lot of the analysts had come along with that sort of mindset. Well, we've always been profitable on the top line, but when you're hitting a 25, 26, 27% adjusted EBITDA, you're a really profitable tech company. And there wasn't a lot of those in Silicon Valley.
Right.
Thoma Bravo saw that. They saw that the fundamentals of the business were sound. So they came in, and quite honestly, when something like that happens, you have activist investors that start to get involved, the PE firms start to circle you. It was really important for us to maintain our culture. So we almost interviewed PE firms and got ahead of the process. And what we found in Thoma Bravo was a company that really didn't want to learn about mortgage. They wanted the management team to know what to do in the mortgage space. They
wanted to keep the jockeys.
Keep the jockeys. They had a lot of technology companies in their portfolio, a lot of security-based technology companies. So they learned early on, let the experts run the company, but give them the right resources. And, let's be honest, we were a company that was growing really fast. So yeah, there were some opportunities for us to get a little bit tighter. And so they brought that discipline to us. And that's the reason why, literally a year and a half later, they sell us for almost triple what they paid.
So that was interesting. You mentioned you had a deck ready to go for someone looking to acquire, and that was going to be something I was going to shy away from, but it sounds like you had a deck ready because you had a lot of people circling and a lot of people getting interested.
Well, so when we were part of Thoma Bravo, we expected that our exit, from a PE firm, they're looking for an exit.
Right.
A typical hold period is 4 to 5 years. We expected that we would likely either become a public company again and be spun out as an IPO, which a lot of PE firms do, or we would ultimately be sold to someone else again.
Right.
Now, we expected that to be in a 4 to 5 year time horizon. So once we're, just a little over a year being part of Thoma Bravo, I think we're all caught a little bit by surprise that ICE proactively reached out and called Thoma Bravo and said, look, I know you've only had this asset for a little while. You probably are expecting to hold it for a lot longer. We'd like to come in now and have a conversation about acquiring it. So what we just heard from Jeff Sprecher, the CEO of ICE, where he will roll the dice, he will bet big, he will come in and make bold moves.
I like that.
That's exactly what he did with Ellie Mae.
Right.
They had already owned MERS, so they had kind of the pure back-end component of the system of record for the ownership and authoritative servicing rights of the loans in MERS. Really interesting story is Ellie Mae tried to acquire Simplifile. And they ran a process, and it came down to two companies that were, at the end of the day, the final bidders. And it was Ellie Mae and ICE. And we knew that the ICE was in the bidding. It didn't matter what number we put out there. They just increased that number by $10 million.
Right.
So at the end of the day, Simplifile traded away to ICE. So it's just come full circle then when ICE acquired us and said, we really want you to bring MERS, Simplifile, and Ellie Mae together as one entity and create this new division as ICE Mortgage Technology. So once he reached out and said, we want to have the meeting, we scrambled. We weren't prepared to sell the company again that fast. We thought we had a 2-3 year runway.
Right.
And so we spent weeks preparing this material. But again, to Jeff's credit, he and Ben and the team had done their homework on us. They knew exactly the position in the market, and they knew that they had the back end, the middle, and what they were just missing was the front end, which we were a perfect complement to now doing this entire end-to-end technology solution for the industry.
So it sounds like it's all positive. Like you're glowing talking about it. It sounds like it's been a great thing. There's got to be a con. Any cons? Any less than optimal things? Feeling public again?
One, you have to do a lot of internal education. This is a very different asset class from what ICE is accustomed to.
It seems like he's pretty hands off. He's like what Joe says. I just call Joe and say, how's business? It seems like they're pretty much let Joe do it.
Don't let them fool you. They give us a tremendous amount of autonomy, but this is a company that gets into the details. And it's not to micromanage you. It's so they understand it. Because once they understand it, then when you come to them and say, hey, I want to invest $10 million in this, they're like, oh, because that's going to solve this problem, right? I'm like, exactly. And that's the beauty of this leadership team is they dive deep into the details and then they...
For the right reason.
For the right reasons. And then they lift up and kind of get out of your way and are there to support you.
Well, it sounds like you're enjoying it.
Oh, really tremendously.
Awesome. So moving on, considering environmental shifts in the LOS space, such as automation through AI and machine learning, which we're going to talk about that a little bit more because you hit on that in Keynote, and a more fragmented service-oriented ecosystem in the broader origination space, how do you see the role of the LOS playing out in 5 years?
Yeah, it's interesting. A lot of people have always looked at the LOS as the system of record in the manufacturing process. And we view that the same way, although we have a little slightly different perspective. We view the LOS as, and we don't really even refer to Encompass as a loan origination system. We view it more as a manufacturing platform. And so when you do that, you've got to be able to really bring two things to bear. One is constant innovation of technology that allows the user of that platform to build their own innovation, which is why we've put such a focus on, all the APIs that we've now made available. And just on stage a few moments ago, we talked about making even more APIs available. So that's one. The other is you've got to open the platform up for anybody else who wants to build on top of it to help solve problems. This is the Salesforce model, where their CRM is a customer relationship management platform, and then they have both APIs that users can consume, and they have all these third-party companies that are building apps or solutions on top of it. Mm-hmm. And that's really the pivot we made a few years ago.
Which I thoroughly love, I got to say, as a partner. I mean, when Megan Pulliam once told me it'll be like Salesforce, I said, I don't know about Ellie Mae getting there, and here we are today.
Absolutely. And that pivot was important because if we were just a loan origination system, then we're just another system that people have got to move data in and out of. And all we're doing is really introducing more friction. Mm-hmm. By making the switch to being truly a platform and people building on top of it and that data flowing natively and naturally between the ecosystem, we remove the friction and allow innovation to happen much faster.
Well, and it's a different kind of way of being sticky. Different take on it versus controlling everything. Trying to change that platform out is going to be pretty rough when you've got a lot of integrations and other technologies built to connect to it.
And we did have to sell that a little bit to to some people of
because that used to be a big revenue model for you.
Yeah, people are like, why would you move away from just being a loan origination system because you have such low attrition? And the response was, that's the point, right? The point is you become the fabric or the framework for the industry, and you allow more and more people to participate in the monetization of what's taking place in the industry. Then you become even more relied upon. And so our goal is, first of all, you have to give a lender choice. You're not going to go to any lender and say, you can't use any other doc provider. You have to use the docs that are part of your investment in Encompass. That's not going to land well. So you have to make sure that your docs is the best experience possible, but you also have to give them the opportunity to use anybody else in a seamless way.
Right.
As we've evolved our thinking over years, and really this happened probably 10 years ago when we introduced this concept of success-based pricing, where we said, we don't want to just be a SaaS company where you have to pay your monthly, toll. We want to basically align with you as our customers. So we know in December and January, you're going to do less loans.
Right.
We also know that in May, June, and July, you're going to do a lot more loans. So when you make more, then you'll pay us more.
Right.
But when you make less, you should pay us less.
Right.
That way we're completely aligned with your business and your success. And so that's really the evolution of where we come from a business perspective, and it now translates into our technology strategy.
So good transition there. What do you think is the biggest competitive threat to ICE mortgage technology?
It's funny, we get asked all the time, especially now that we're part of ICE, right, and you have all these analysts that have no idea about what the mortgage industry is like. And we're on all these investor calls and they say, so remind us again, who's your number one competitor? And, our number one competitor is still proprietary systems. If you look at from a market share perspective, whether that's lenders or users or loans, the real driving factor here is volume. Like, what are the systems that volume is going through? And from that perspective, our top competitor is these legacy proprietary systems that maybe somebody got a kernel a number of years ago and have built on top of, or, maybe it's purely organic tech that they've had, around for 10, 15 years. Mm-hmm. What's been great about what we've seen over the last few years is a lot of those companies are predominantly banks, but they've realized that they ceded so much of the market to these independent mortgage bankers who are using a commercial solution like ours, but still innovating on top of it, so that as all these regulations come, they don't have to worry about that. We do all that heavy lifting for them. So whether it's TRID or IRLA or whatever the next thing is that's going to come, our lenders just heads down, keep originating and keep innovating because we take care of all the compliance issues. Those companies that have been on proprietary systems, their 800 developers are spending time just maintaining their systems and trying to just keep it up with the changing compliance landscape. So as a result, their innovation has really lagged behind the independent mortgage bankers. They're now realizing that. they're realizing it's better for them to invest in R&D to make the experience better for their consumers and help them win share back than hold on to these legacy systems. So we're engaged in some really interesting conversations now that we hadn't been for several years.
So a lot of change and impacts by the pandemic. Erla was one of those big changes in the past couple of years that I think you guys tackled pretty well. That must have been, I don't want to know the number of man hours there. But what's something you would have changed or approached differently in the past few years? I know you guys are really tackling eClose now. I think that kind of got thrown at the front of the bus. What's something you may have changed in the last few years that you guys have handled?
Yeah, I mean, with all the regulatory changes, you have to adapt to. Every year you may end up having 60% of your roadmap you have no control over because Erla comes in and it's going to dominate everything you do. And so it's kind of good news, bad news. The bad news is because everything is so tightly integrated, because it's really not like a separate docs solution, it's more of a print function within the Encompass platform. And it's not really a separate compliance service. It's really a compliance engine that sits natively within the Encompass platform. With you making one change, you got to change everything. Mm-hmm. So when compliance comes, it's heavy lift for us. The good news for us, though, is because everything's so tightly integrated, it allows us really to be able to move things much quicker. Now, with eClose, that's probably the one thing we would have done differently. We waited on eClose until we felt we not had all the components built, but we had the strategy really well defined. And the challenge
lenders ready to adopt. Well, and they were forced to want to adopt real quick.
The problem is when you talk to lenders, we would hear from lenders that the number one thing they wanted us to tackle was eClose. But when you'd ask them, well, what does eClose mean? We got 100 different definitions, from everything to it's just being able to sign to it's automated disclosures to it's back end delivery to making sure that it's going to be eNotes with an eVault. And as we then talk to the lenders about, okay, let's imagine we had all that today. How would you handle that? How would you adopt it? How would you shift that? And how are your secondary market providers prepared to accept it? We got a lot of blank stares because they hadn't really thought through the change management or the downstream implications. And so we spent a lot of time kind of behind the scenes that nobody knew about, working with the aggregators, helping them understand how this would be a differentiated experience, how they could have confidence in eNotes. And then we started finding out that the entire secondary market had absolutely no idea how they would handle the videos for remote online notarization. How do we get it? These notaries, 65 years old, they do it on their laptop, they could retire tomorrow. And then there's an issue with that loan and I end up litigating. How am I ever going to get proof that that was the borrower who signed? So it was a fundamental problem. So we solved it. So with MERS is going to become the industry's repository for RON videos. We will link the RON video with the MIN number, so it will always stay with that loan wherever it goes as transfer of ownership or servicing rights gets moved from one entity to another. Now, in hindsight, I wish we hadn't waited. So yes, we've solved the problem for the industry, but we could have been doing at least hybrid years ago. And that's what really got us focused on this 1% adoption.
You're cutting me off there. I love it. That's exactly.
Let's start with whatever we have and let's increment and continue to make it better. That's what drove our NG journey, where we were trying to create this end-to-end solution. Instead, we said, about a year and a half ago, we said, let's pivot. Let's just deliver. Let's start with correspondent. Let's deliver what we can there, and let's create as many automation and advantages for our correspondent lenders as we can. But let's not try to do everything A to Z. We'll get there over time. But right now, we've got lenders that are struggling with high costs of origination and acquisition. Let's start to solve some of their problems, even if we don't solve all of them.
Right. We talked about the Simon Sinek. He says people love to say that people don't like change, and really they just don't like drastic, abrupt change. And people that may not have seen the general session, you touched on the 1%. Can you kind of talk about that a little bit?
Yeah, absolutely. It's really a mindset that we've adopted at ICE, which is let's not let perfection stand in the way of progress. And so, it's a perfect example. Nancy Alley, who runs our whole eClose strategy, she was basically saying, look, if you have 100 borrowers who are going through the experience, you could have 50 of those borrowers have an incredible eClose experience. but you're not allowing them to have that. You're denying them that experience until you feel like you could give 100% that great experience. That might not come for a long time. Or you know what? Some of them might not even want it. So why are you denying a large percent of your customers a better experience simply because you don't want to bifurcate your process? So we said, okay, let's make it so they don't bifurcate their operational procedures. Let's create a one workflow. So as a user in Encompass, I might not even know if the packages are going to end up being e-signed or wet signed. I'm just going through my normal process. And that's what we're really about, is take advantage of what you have available right now. Stephanie talked about it. Stephanie Derflinger in our keynote, she said, automate flood. You know,
the flood cert, that's pretty,
cut
nobody's
one day,
going to get mad at you for that one.
Cut one day off of your process. Then automate fraud ordering. Cut another day off of your process. When you add up this incremental change, you're going to find yourself looking back going, hey, we just saved 15 days in the process. How did we do that? You did it 1% at a time.
I love it. I love it. The other thing you talked about that it was super interesting to me was your AI and machine learning, the potential regulatory ramifications that might rear its ugly head that were just unforeseen byproducts of machine learning and AI. Can you talk a little bit more about that?
Yeah, I mean, you see this all the time, but you don't recognize it when it happens. Just look at the Netflix algorithms. Have you ever gone into Netflix and you've logged in and it's got recommendations for you and you're like, yeah, that's interesting. That's interesting. What is that?
Yeah, my wife was using my account again. Dang it.
Right. but you know, it served something up and it's like, well, that doesn't make any sense. I'm not interested in that. But it's not a big deal because it's Netflix. But when you use algorithms, if there's any possibility of unintended bias being introduced because of the way the algorithms are written or because of the data that it's taking in or the way it's calculating its results, you could find people that are kind of looking on the outside in simply because of the use of artificial intelligence or machine learning. And so we have to be really careful to have a governance structure around any development of automation that's using machine learning or artificial intelligence. You've got to make sure that first, it's incredibly well documented of exactly what it does and how the algorithms work. You've then got to give threshold capabilities for adjustments to the users, because it can't be my definition of how you should lend. It always has to be your definition, because your risk profile might be different from the next lender or the next lender. But you want to make sure that they understand how they're using it, because the last thing we want to have is algorithms that are kind of doing this prediction of who's going to be creditworthy and who's not, when you're not taking into all the factors that need to be incorporated to make that decision. And so it's like our saying at ICE is, the only thing worse than a bad process is an automated bad process, because then it happens and you don't even know it's happening.
Interesting. Have you seen any regulation formally yet, or just the CFPB, you can see it when they're requesting input?
So I view this as kind of the shot across the bow. So the CFPB has put out their RFI saying, we want to understand what you're doing and how you're using it. The FHFA published an advisory bulletin on kind of very high-level loose guidance on how that you should be thinking about machine learning and AI, more from a, do this thoughtfully was the recommendation. It's the tip of the spear.
Well, yeah, usually the high-level guidance is this is coming.
Absolutely, and we know it is coming. And so with all the focus on how do we better serve underserved markets, you're on a collision course of, well, we want to streamline the process and we want to use artificial intelligence, but at the same time, we want to be highly inclusive. You can accomplish both. You just have to be thoughtful and you have to put governance around it to make sure you don't introduce any unintended bias.
Exactly. It's definitely, I never thought I'd be scared about implementing AI or machine learning.
Skynet.
Yeah. So the other thing that's interesting today, you guys are announcing more. Is it Data Insights is going to be? Is there new data coming out, or is this is a totally new product? Or
so we've had a product called Insights, and what's unique about this product, nobody in the industry has this. It provides you as a lender with real-time access to understand how you are competing with other lenders that look like you in the market.
I mean, you guys have all the data for it.
We have all the data, and what's interesting is, and we do it on an anonymized basis. Right. So, we have kind of all the security protocols in place to make sure that nobody could be identified. But if you think about, if you want to know, well, how am I doing in a specific zip code? There really isn't anything that could tell you that. If you want to know how I'm doing in general versus my competitors, you wait until like Mortgage Finance comes out with a quarterly publication, or you wait until September when HMDA data comes out. The problem with both of those is it's too late to make any adjustments to improve your competitive position. So we created this insights product that would basically say, I want to look at this zip code, I want to look at this loan product. Where is my rate compared to, my top 5 competitors that look like me or the same sort of charter that I am, same sort of size of origination capability. And it was a phenomenal product that nobody used. And nobody used it because we introduced it in 2020, right before the pandemic hit.
So it's funny you said that, because one of the questions I wanted to ask you as ICE Mortgage Technology, I'm guilty of it, I think Encompass still. What is something, or what are the products that you think are most underutilized? And now we just got that one.
Yeah, this is a perfect one. So here we have this solution that nobody else has that provides incredible business insight that allows you to make changes right now.
And specific to you. I think that's the important thing.
Yeah, to effectuate an outcome for you as a lender. And nobody used it. Well, nobody used it because they were busy.
Right.
They had more volume than they could handle. They didn't need something to tell them how to be more competitive. They were having to turn people away.
Right. Were there any insights that you found to be surprising during that process?
Yeah. I mean, for one, here we thought we had kind of like, a silver bullet. And everybody was like, we absolutely agree it's a phenomenal product. We have no need for it because we're just too busy. So as we knew that the pandemic, was starting to come down and you see the volume start to shift to being more of a purchase-centric market, all of a sudden that insight's going to become a lot more interesting to lenders. Mm-hmm. So we decided to take the Insights product and we combined it with another solution that we have always made available called the Millennial Tracker. So the Millennial Tracker has been a free tool to give you insight to where are millennials buying homes, what type of loan products are they using, what's the average debt-to-income ratio or loan-to-value of this next generation of home buyers. We've combined the two and we're exposing a lot of those elements for free on our website, just so that lenders can start to get, acclimated back to using data to make decisions because they're not in a situation where they're just turning business away.
Right. So how important do you, now that we're at this conference, it seems like, this is the first time I've been in a room without a mask on. It feels weird. I don't know about you, but sometimes I watch a movie and I'm like, look at all the people there.
Yeah.
How important do you think I feel like the mortgage industry is kind of has a conference culture. I mean, how important do you think it is for the industry having these conferences and being back in person?
I think that, our business more so than many other industries is a relationship business. If you think about, especially when you're back into a purchase-centric market, it's all about the relationships. It's the relationships that loan officers have with realtors have with the consumer. It's about the trust that gets established there. And so I think being at these conferences gives people that opportunity to make that connection, to strengthen or to build new relationships. And what we hear so many times from people that leave the conference is everybody that's in that exhibit hall, their products and services are available to all of our customers right now. So unlike other conferences, you're going to go and you're going to talk to somebody about a solution. You can literally turn it on tomorrow. Mm-hmm. And so that's what makes, this conference so unique. And it's the reason why we are, committed to continuing to do it, because we're bringing the entire industry together to solve problems, right? It's the whole strategy about being an open platform. If we really want to innovate and we want to automate everything, we're not going to be able to do that by ourselves. We need the community to be involved. So you got to bring the community together so that they can create those relationships and you can expose them to the things that are available in the system they use every day. They just don't even know it.
So we're going to be seeing more of Vegas for the ICE experience?
We are committed to being in Vegas for the next 3 years.
All right.
And there's actually a contract on my desk to extend it beyond that. The Wynn is probably the best venue.
For exercise.
Well, for exercise, but they made a massive investment in expanding this conference space. And so the venue is just incredible. But, now we're not Ellie Mae putting on experience. Now we're ICE putting on an experience. And so this year, we had about 2,500 people registered to attend. I'm sure a few more showed up, so the number's probably a little higher. We would expect,
and that's at the tail end of a pandemic.
We would expect next year it's probably going to be closer to 3,500, and that's if we keep it to just the mortgage technology division of ICE. There's opportunities for, growth and being able to expand well beyond just what we do. The president of the New York Stock Exchange, Lynn Martin, she's been at the conference for the last 2 days. And so it gives us an opportunity to really think about how can we leverage this incredible venue, bring people together, and start to look at how we do a lot of cross-pollination. There's a lot of our partners and customers that are public companies or are thinking about going public. There's a lot of our customers that consume data. We have a $1 billion data business as part of ICE. So I think this is really just the start of an incredible beginning.
Well, thanks for having us here, and thanks for joining us for the show. We like to end every show with, giving you 30 seconds to kind of plug whatever it is you may like to plug, Joe.
Yeah, I would just kind of continue with the theme we talked about at the keynote, which is for all the listeners, there's opportunities to help people that want to participate in home ownership. It's about learning about that bond program, learning about that down payment assistance program, and then making the experience the best that you can by taking advantage of automating even just one part of the process to provide a better experience for those borrowers. And so, our message is start today. Cultivate those habits of inclusion and speed in the process, and let us know what we can do to help.
Well, thank you. You've done great. I saw you go from speaker to interviewer to interviewee in about an hour and a half, and you've done great. Thank you for being on.
Appreciate it, Mace.
Have a good one.
You too.